I've been parroting this statement of my own, basically repeating it to whoever wants to listen, that the most active secondary market in the Indian context is around companies that are path to profitable or path to IPO. So if that event was happening within 1 or 2 or 3 years from today, that's when secondary activity is beginning to spike in that company. Now, whether that is through a portfolio or through a single asset doesn't matter, but that's when there's interest in the company. Most secondary buyers are saying, I don't want to wait 5 years for liquidity, 6 years for liquidity. I want something which has more assurance of a shorter term liquidity. And ideally, that should be more in my control, not an MPA. It should be more like an IPO. And therefore, my belief is that most of what you'll see over the next 5-6 years in India around secondaries will be implicitly a vote that this company is likely to move up. So we'll come to each of the companies, but we're also seeing portfolios being constructed only around such assets. So there was a rumored portfolio of Peak 15 that was in the market. Peak 15 has also been doing direct secondaries in a lot of companies, wherever they can, much like how they're selling post-IPO positions. A Z47 had very strong fintech assets. Tiger has a very strong set of fintech assets, which are multi-billion dollar assets. And rumor is that they were trying to sell $100 million plus lots of each of these so that they can get a portfolio liquidity. These are all in the private domain, so it's very difficult to know whether these have concluded, what the pricing was, what the discounts were. But rest assured, those are chunkier assets that are getting a lot of interest in the market today. Last year, Chiratae did something which was even in the newspapers. I think that was like 75 million, close to that number. And it was predominantly lens card, from what I remember, that article. So the smaller funds, so what's happening in the secondary market is partly for one of the two reasons I mentioned. Either that managers need to show some liquidity because they're going to market to raise capital, someone like Blume today, or the fund is reaching end of life in the next 2 to 3 years. There's pressure to stitch together second. So far we have never had the second type of pressure other than for Fund 1. But now Fund 2 has reached 9 years. So we have that second type of pressure kicking in for Fund 2 as well. Fund 3 doesn't have that pressure because we're not anywhere close to end of life. But in the next 3 years, if you don't show liquidity, then people will frown upon it because we're 6 years in. And therefore, we have the first type of pressure. So this is where broadly the fund universe lies. Okay, that's step 1.